Elliott Wave forecast. If you follow the stock market closely, then you probably know of some of the biggest names of Elliott Wave analysts. When the Elliott Wave forecast proves correct, they are actively seeking out that high. When the market starts to go down, they're begging for it to keep going. With the Elliott Wave forecast heading north, these big-time analysts still have wave counts to back up their arguments. Regardless of the fact that from 2000 to 2003, and from 2007 to 2009 the market was considered a bear market, Elliott analysts are still seen as being wrong in practicing their theories. If all wave principal analysts had their way, the market would be starting a 50-year bull market, leaving every trader rich. There is a reason for the direction the Elliott Wave forecast has headed. Let's face it, it's been proven that wave principal patterns are a lot cleaner when the market is in decline. Large declines tend to become a huge emotional affair, making it appear that this forecast predicted a recession, hence heading it in a descending spiral. Also, most businesses, both large and small, don't want to meet those incredibly condescending expectations that are constantly being placed on them when the market is going well. Because of this, many investors and traders seem to look for a fast exit. These highly emotional situations can sway the Elliott Wave forecast significantly in several different directions. At this point, sharp trends can usually be seen, and they almost always support clear wave principal patterns. Comparing just this decades to bull markets to the decades to bear markets confirms these patterns. Despite this forecast, advances show that it's a lot more difficult for a price to go up than it is for it to go down. This may corrupt how useful this theory actually is, forcing analysts to make one bearish call after another. If you allow the bears to demolish your impression of this theory, you will be missing out on the most accurate forecasting method on the market, the Elliott Wave forecast, as long as it is applied objectively. In order to fully comprehend how to use the wave principal method and the Elliott Wave forecast theory, it is important to research and learn the specific rules of the theory and how to objectively apply these rules to pricing charts. It is also exceptionally important to know the limitations of this theory. The Elliott Wave forecast makes it more difficult to forecast up trends than down trends. However, you must understand that a true wave count can't be solely determined in an objective manner because of the vast amount of possibilities. When you have a forecasting theory such as the Elliott Wave forecast that is able to predict even the smallest price movements down to a mere second, it can be quite difficult for Elliott analysts to not abuse this power. Forecasting using this theory is an art that needs to be mastered. As long as you can identify specific time frames when the exact wave count is not known, your approach on how to handle the trading market can be adjusted accordingly. Pay attention to the Elliott Wave forecast as well as current market trends. You will find yourself trading like an Elliott analyst in no time.